What we are looking at is our financial reporting package, and this is built in a software called Fathom. And what you see on the screen is the first page, and this is the KPI page. This is the KPI listing. And what we look at on a monthly basis are 15 KPIs, which we feel best represent the things that a marketing agency should be actively tracking. So what we have is total revenue, revenue per employee, labor efficiency ratio, production margin, profitability ratio, return on capital employed, working capital absorption, current ratio, cash ratio, operating cash flow, cash on hand, cash reserves versus cash reserve target versus a budgeted cash reserve, revenue growth, earnings before interest and tax, that's what EBIT stands for, the growth of that, and then growth equilibrium. All of these metrics are tracked against a target, and we look at both year to date, wherever we are in the year, and we also look at last months when we have advisory type conversations. So that's where we start when we have advisory type conversations on a monthly basis with marketing agencies. The first metric that we're going to look at is total revenue, and we can click in here, we can see what total revenue is year to date, and we can also look at our target. Our target is generally going to be our budget. Total revenue is just the top line revenue of the agency. So how much have you brought in from customers in exchange for services on a year-to-date basis and also monthly. The next metric we're going to look at is revenue per employee. Revenue per employee is your top line revenue, so your gross revenue, divided by the number of employees or your headcount that you have. What we're looking for on a yearly basis is at least $150,000, and that is an industry standard metric. Higher is better, lower is worse, obviously. What we're looking at right here is a target of $75,000. That represents 6 months worth of operations. So basically $150,000 divided by 2. And then this is the amount of revenue per employee that we've generated year to date thus far. Labor efficiency ratio is the gross revenue divided by payroll expenses. In other words, this is a measure of how well you are leveraging the people to generate revenue in your agency. Generally, what we're looking for is a target of 2.5. So in other words, for every dollar of revenue that you're generating, you're spending about 40 cents of that on payroll-related costs. The next KPI that we're going to look at is production margin. So production margin is gross revenue minus cost of sales. So if you're looking at QuickBooks, this is your cost of goods sold. So the variable expenses that you have in your business in order to drive a dollar of revenue. Variable expenses only exist if they're attached to a dollar of revenue. So total revenue minus cost of goods sold or cost of sales, whatever you want to call it, minus production related payroll costs. What we're looking for here is a target of 55%. 55% basically ensures that you're going to be profitable in your agency. Anything north of 50% is good. Anything below 50%, generally we're having conversations about what we need to do around margins and or generating revenue. The next KPI we're going to look at is our profitability ratio. Our profitability ratio is our earnings before interest and tax, so our EBIT, divided into our revenue. So in other words, it's basically for every dollar of revenue that you're generating, how much of it are you keeping in order to pay yourself or to reinvest back in the business? The next metric is our return on capital employed. And what this basically measures is how much capital have we put into the business and then what return are we getting on that investment by operating the business. It's a really good metric to understand the leverage that you're getting from the money and the investment that you've made in monetary terms into your agency. Our next metric is working capital absorption, and this basically is measuring the adequacy of the working capital in the business and its ability to generate revenue. The next KPI we're going to look at is our current ratio. The current ratio is one of the classic ratios that comes out of accounting. It is a measure of liquidity in your business. The target is 3.15. That is an industry benchmark from benchmark data. What we want is something north of 2. And the way that this is calculated is current assets divided by current liabilities. Current assets generally meaning cash and accounts receivable inside of an agency. Current liabilities are generally going to be accounts payable or things like wages payable, things that you're going to pay in the short term. So divide those into each other, so current liabilities into current assets, that gives you your current ratio. It can also be represented in nominal terms by subtracting current liabilities from current assets, and that's basically known as working capital. Our next KPI is our cash ratio. Our cash ratio is calculated by taking our cash and then dividing that into our current liabilities. So how much cash do we have in order to pay for the things that we currently owe? Generally going to be accounts payable, wages payable, things like that. Our next KPI is operating cash flow. Operating cash flow is otherwise known as your cash flow from operations. So how much cash is the business kicking off from the operations of its business? There are three different types of cash flow. One is operating cash flow, one is investing cash flow. So what are you making from investing? Generally, it's going to be a negative number for an agency because generally it's going to be buying equipment as opposed to making investments like buying stocks or bonds or things like that. And then the other is financing cash flow. Financing cash flow, cash coming in is going to be taken from debt, and then cash going out on the financing side is going to be paying down debt. Operating cash flow is the cash flow from actually operating the business. That's why it's so important, because if your business can be profitable, but maybe it doesn't kick off any cash. We need that cash flow because everything at the end of the day needs to turn into cash. You have to pay your people with cash. You have to pay yourself with cash. You've got to pay your mortgage with cash. Everything needs to turn into cash, and that's why operating cash flow is so important. Our next KPI is cash on hand, and the one after that actually is cash reserves. And those two go hand in hand. If you're interested in cash reserves and how much cash you should be keeping in your business, we have a great video and we've got a great calculator on our website. You can find the video on YouTube. But cash on hand is basically just the amount of cash that you have in the business, and we need to look at these things in the context of each other because maybe this is enough cash, maybe it's not. That's going to be determined by your cash reserve target, and your cash reserve target is going to be determined by going through a set of questions and determining exactly how much cash you need to keep in the business, somewhere between 2 and 6 months of cash. Multiply that by your fixed expenses, and that's what your cash reserve target is going to be. So these two KPIs need to be looked at within the context of each other. Our next KPI is revenue growth. So what is the percentage growth of your top line revenue in your agency? It's a super important metric to understand how fast your agency is growing. And we also need to understand this within the context of our net margin. Generally speaking, our growth rate plus our net margin should equal about 40%. It's called the rule of 40. And basically what that says is the faster that you grow, probably the less profitable you're going to be. And the reason being is you have to make investments in your growth before your actual growth occurs, before you actually realize cash from that growth. Our next KPI is EBIT growth. EBIT growth is a derivative of revenue growth, and we need to be looking at this within the context of revenue growth as well. If revenue is growing at 10%, theoretically, we'd also like to see EBIT growth at 10% or higher. It's a measure of how well we are controlling our costs to look at revenue growth and EBIT growth within the context of each other. But if revenue is growing and EBIT is not growing, that means yes, we're growing revenue, yes, we're growing the agency, yes, that's going well, but it's not necessarily turning into more profit and more cash, and that is a problem. So we need to look at these two things within the context of each other. Our final KPI is growth equilibrium. This is a measure of how much growth you can finance in the agency without taking on outside investment, without taking on outside debt. So how much of the agency growth can you self-finance? Super important metric. For an agency or any service type business for that matter, this should basically be infinite. You should be able to finance all of your growth through self-financing and through the operations of the business. So that's our KPI list. The next list that we're going to look at is our KPI Explorer. All of the KPIs you may have noticed on the KPI list had a level of importance assigned to them. And the level of importance is either going to be critical, high, medium, or low. This will give you the perspective of the various types of KPIs that we're looking at. How many profitability ratios we have, how many efficiency KPIs we have, how many asset usage KPIs we have, liquidity, cash flow, and growth. The more important way to look at this, and the way that we love to have advisory conversations, is to sort this by importance. When we sort this by importance, we can see what the problem areas are, and then we can start to fix them. The way to do this is to start on the right, work your way left until you find your first red X, and then that's what we need to be focusing on. So our operating cash flow is good, our revenue is good, our profitability ratio is good, it's being managed well this year, our production margin is good, that's great. Our labor efficiency ratio, not good. So what we need to be doing in this particular instance is looking at the people that we have in the business, where our payroll expenses are going, and determining whether or not we're using those resources as efficiently as we possibly can. So that is how we use the KPI Explorer, and that is the way that we prioritize our advisory conversations and how we determine what we're going to focus on in the agency in order to drive the agency forward. The next area I'd like to show you is our Goal Seek page, and basically what this does is it shows us how we can get from here to there at a super high level. So in this particular case, what we're looking at is profitability ratio. If we want to take our profitability ratio from 2.26% to 2.48%, let's just say maybe this is 5. So we're basically going to double our profitability. How would we get there? What are the things that we need to do? So here, price needs to go up 3%, volume needs to go up about 3.5%. Our variable cost of sales, this is otherwise known as our COGS, needs to go down 14%, fixed expenses needs to go down 3%, and then from here we can basically do a what if analysis. Well, what if it's not 3%? What if it's 5? There we go, 5. Oops. Basically, we don't even need to get to 5. We can do 2.89% and we can achieve all of our goals. But we can do a what if analysis here and figure out where are the levers that we need to pull, and then we can have conversations around that and strategize around that about how we accomplish that. The final thing I'm going to show in our financial reporting package is our forecast tab. And this is a three-way forecast. What a three-way forecast is, it forecasts the P&L, it forecasts the balance sheet, so we can see assets and liabilities, we can see cash, we can see credit cards, we can see loans and how those are affected by the performance of the agency on the P&L, and then also our cash flow statement. So we can see the 3 different types of cash: operating cash flow, investing cash flow, and financing cash flow. This is really cool, and we can forecast the various line items on the P&L any which way that we want to, and we can do the same for the balance sheet as well. The power here comes from micro forecasts, and what micro forecasts are tiny forecasts that feed into the whole forecast. An example of a micro forecast might be bringing on a new customer at $1,000 a month. If we add that in, what does that do to the projections? And we can do that in real time as we talk through the forecast with a customer. We can do it for revenue, we can do it for expenses, we can do it for a combination, and we can also do this on the balance sheet as well. So what happens if we decide to pay down more debt? What does that debt level look like over time? These are really important things that we need to talk about so we can plan and strategize how we're going to move an agency forward from a financial perspective.